Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliette Sarli. Great to have your company on the final trading day of the first full week of 2026. The local market is down by about 0.1% as we round out the session there on the CBO 200. A similar decline, or in fact, we're pretty flat on the ASX 200, just down by 5 points. A little bit of trepidation, of course, ahead of the key non-farm payrolls data coming through in the US tonight. Over the last 5 days, the index virtually unchanged. We're still about 4.4%, though, below those records we reached late last year. And that's kind of a little bit dissimilar to what you're seeing in global markets when you've seen the MSCI Asia Pacific Index, the Dow, the S&P 500 this week, all hit record highs. We know we are a little bit of a different market, though, and we also have to take into account the fact that we are in our summer and there's very low trading volumes with very few people actually rocking up to work at the moment. But today's themes are really about this mega mining merger, question mark, of course, because is it going to go ahead? So we woke up to news that Rio Tinto and Glencore had confirmed that they are in merger talks. It would be an all-cash takeover. It would also create the world's biggest miner worth some $210 billion US. Now, under UK takeover rules, Rio has until 5 p.m. on February 5th to declare that it is actually making a takeover for Glencore. You saw Glencore shares absolutely rocket higher on Wall Street overnight, but Rio Tinto has been a laggard today. A little bit of uncertainty as to what this means. They would control 7% of the world's global copper output. 50 weeks to go. So we mentioned that, of course, today or this week is the first full trading week of 2026, but we did actually have a few days last week, or at least one trading day on Friday the 2nd. So we've got 50 weeks to go, and as I mentioned, we're down about 4.4% from our record high reached in October last year. But everyone I've been speaking to is so positive about 2026. So let's hope that the year of the horse is going to be a good one for investors. And then, of course, payrolls pending. It really is about this non-farm payrolls data out of the US tonight, what it means for the Fed's path, and of course, a very turbulent time ahead, I guess, as we await to see who's going to be the new Fed chair as well. Let's get into some of the sectoral moves, kicking it off with some of these energy players. Santos having a great session, up 3.5%. Woodside, Karoon, Ampol and Beach Energy. So the energy sector is certainly a big front runner today and helping to take some of the heat away from that loss that you've seen in the materials sector, really dragged lower by the decline in Rio Tinto. So Rio down by 6.4%, showing the trepidation that some investors have about this Glencore bid, potentially thinking that they are offering too much, perhaps. BHP up by 1%, Fortescue South 32, Minres, all looking good as we see a rebound coming through in iron ore. And looking where the banks are finishing the week, CommBank, I think CommBank started 2026 around 160, so it's lost about $8 over the past few trading days. Macquarie Group down by about 1.7%. Some of the corporate news we're following, we've touched on Rio Tinto, also Northern Star defending its market disclosures following an ASX query. Champion Iron saying rail services resumed after a train derailment. And Code, and gosh, what a standout there. The tech firm that's also exposed to the mining sector, expecting first half earnings to jump by 52% on higher demand for metal detection equipment. Shares there hitting a record high today. Mesoblast, we spoke to them earlier. They say revenue from their Ryoncil treatment jumped by nearly 2/3 over the December quarter. You can catch that interview with the CEO of Mesoblast on our website, ausbiz.com.au. Aristocrat Leisure also moving higher. It's decided to extend its on-market share buyback, and Atlas Arteria down by about 1.1%. All right, let's discuss it all now. And welcome to the COB, Andrew Coleman from Team Invest. And cheers to you. We don't normally drink wine on the COB, but we thought we'd keep it going. Great to see you, Andrew. You take a sip while I continue to talk, otherwise it'll be a bit awkward. But, how have you viewed the first, what have we had, 6 trading days of 2026?
I think it's pretty much been a continuation of December, hasn't it? Probably because in Australia, as you mentioned before, the vast majority of market participants are probably still at the beach enjoying the weather out there rather than sitting in front of a computer. I think it's interesting, though, your comment before, and I've been reading it a lot as well in the press at the moment, about the general bullishness in the market. And in fact, there was an article in the AFR only a few days ago that there wasn't a single market commentator that they were interviewing who didn't think this was going to be another record year with double-digit growth. And that gets my spidey sense tingling, because there is nothing more guaranteed throughout history to be wrong than the consensus of a very large, unanimous consensus of a very large group of people. There's an amazing thing about human nature, isn't it? That when we all believe nothing can go wrong, something goes wrong. And when we all believe nothing can go right, surprisingly, something turns out for the better. And I think the big fear for me, and I think for all value investors in the market at the moment, has got to be, how long can we keep defying gravity and having a share market run ahead of the underlying economic fundamentals, whether that's in Australia or the United States or Europe or Asia? Because if you look at the economic health of most of the world, the end of 2025, we're not in great shape. If you look at the markets around most of the world, it's been break out the champagne. So it'll be interesting to see which of those wins in the year ahead.
And how are you viewing the overall economic picture? Let's discuss locally, given we had that cooling inflation data, but that is not December, that is not January, and I don't know about you, but everywhere I go, it's packed, people are spending.
Yeah, I think at the end of the day, inflation is the lagging indicator, right? It's the outcome of the decisions we're making. And if you think about the main sort of items that impact people's spending ability or behaviour from an economic standpoint, it's unemployment, which is relatively low. It's productivity growth, which is counteracting that because it's relatively low, and it's sentiment. How much are we prepared to really spend? And I think what's interesting is you've got those three moving in separate directions, don't you? You've got unemployment steady at very low numbers, which is good. You've got cost inflation and productivity problems, so that's the opposite direction. And then you've got sentiment, as we've just talked about with the market, far outstripping fundamentals. So I'm not shocked that we're seeing higher inflation reads than we expected a few months ago, on the basis that sentiment is driving that in the short term. But I think in the long term, we're in for some economic pain. Now, whether that economic pain is broad or narrow and focused, who knows? That's the billion-dollar question, right? But you can't continue to have an economy with very limited productivity growth, very limited improvements, and continue to justify markets running ahead, inflation running ahead, until eventually the music stops and someone wakes up and realises it's past midnight and our carriage has turned into a pumpkin.
Oh, yes, don't want that. Don't want to be looking for your glass shoe or slipper. I know that Team Invest doesn't necessarily invest in the miners, but I'm just curious to get your thoughts on the M&A momentum that we've seen to kickstart 2026. So BlueScope saying no to SGH, Rio and Glencore potentially tying up. I mean, is it going to be a merger year? What do you think?
Well, M&A in the mining sector is always linked to the commodity price. I was actually a resources banker back in my very early days straight out of university. So it's an area, M&A resources, so it's an area that I'm very familiar with, albeit probably 20 years out of date now. But at the end of the day, if commodity prices are rising, miners are going to look to do M&A because they are cashed up, their scrip is worth a lot, so their shares are on a good PE, and that's the opportunity to buy assets, particularly from more distressed players, or at the very big end of town, do the sort of trophy mergers that they've been aiming for years but couldn't quite get over the line. So should we expect to see a lot of that this year if the commodity price is high? Absolutely. The question is whether that will be accretive or dilutive in the long term for shareholders. And I think if you look at the M&A cycle of Australian miners, large miners, on average, 2/3 of the time, they have been poor for shareholders in the long run, mainly because they're done at the top of the market. For the same reason why you suddenly feel as a management team and board that you've got all the cash and all the scrip value to go out and buy assets, usually it's the wrong time. I mean, if you think of it, we've just had Boxing Day sales. When was the right time to buy? In the Boxing Day sale, not a week before when prices were high leading into Christmas.
Yes, well, obviously retail very much in focus, and we're getting a household spending insight on Monday as well. What do you think are the key themes for 2026? Is it more of the same? Is it AI? Is it anything that sort of fuels that, data centres?
It's a good question. I think we sort of have an attention span of humans of somewhere between 6 and 18 months. So given we've run with data centres now as a market for 12, 18 months, I don't think they'll be the theme at the end of the year. That's not to say there won't be more data centres still being built or more AI being used. I just think we'll have moved on as humans to something newer, shinier, fancier. I mean, think about the banks at the start of last year towards the end, right?
Yeah.
The market runs hot in something for 1 or 2 quarters, and then you need to find the next big thing if you're a fund manager to talk about. So you've got to move on to the next one. I do think, though, the theme of 2026, from my point of view, and I think most long-term investors' point of view, is going to be watching that bifurcation of PE ratios and how that plays out. So we've talked about that a little bit before, you and I, but in theory, the market PE ratios from sort of lowest PE to highest PE should have some form of normal or Gaussian distribution. In other words, there should be a very small number of companies on stupidly low PEs, a very small number of companies on very high PEs, and everyone else around the market average. And if you look at world data at the moment across most markets, we have seen an inversion of that curve. We see lots of really low PE companies and lots of really high PE companies, and very little in that hollowed out middle. That has got to at some point snap back. That's going to be, I think, the theme towards the back end of 2026, of course, with the big caveat of the person in the White House.
Yeah.
Because I don't think he knows what he's going to do next week, so how can we know?
And I mean, we all woke up on Saturday to that news out of Venezuela. When you look at the market sentiment, though, kind of shrugged off. Have we become used to Trump 2.0?
I think the market's become used to Trump 2.0. I'm not sure we as
Humans.
an economy or as humans or as a society can ever get used to that. But really, you raise a very valid point, which is that there have been a number of actions in the last 6 months that individually would have been the theme of a year in global politics in almost any other period I can imagine. And yet now they last in the news cycle for 4 to 5 days before we've moved on to the next one, because of the sheer volume of information that keeps coming out. That cannot be good for business. So if you take out the politics side of it, take out the social side of it, which I'm sure everyone has their own view on. But from a business owner point of view, and in the end, that's what's driving the economy, how are you able to commit to large capital allocation decisions right now when you don't know what the rules of the game are going to be a month ahead, let alone 6, 12, 2 years, 5 years, 10 years ahead? And I think if you look at why is it that the world's got a productivity problem, it's 2 things. It's that uncertainty drives poor investing. And secondly, it's been a series of regulatory changes, particularly in Australia, but globally, that have driven active managers out of capital allocation and into passive managers. And of course, if no one's looking at how is the capital being allocated, or I should phrase that, they're looking at how the capital is being allocated based on a series of regulations and rules rather than does it add value to the underlying operations, then we shouldn't be surprised that return on equity, return on capital and productivity, which is the outcome of those, is declining.
Andrew, great to have you with us. Hope it's not your last COB appearance. We'll hopefully get you back on quite a few more times in 2026. Always good to see you.
Thank
Andrew
you.
Coleman from Team Invest. Getting back to stock specifics, of course, we were speaking very closely about Rio Tinto today, which was the stock of our day. And Andrew spoke to Adam Dawes from Shaw & Partners, Jun Bei Liu from TenCap.
It is really about the copper side of things, because Rio as well as Glencore had positioned themselves a decade ago or even longer on the iron ore trade for the industrialization of China. Potentially that trade has now started to subside, and then obviously, you know, we do know that China's looking elsewhere for their iron ore and things like that. So they have to move into the future, I suspect, and certainly something like a copper is something that they would definitely want.
It certainly seems like the mining companies, you know, they are trying to capitalize on the current cash flow, high commodity prices, and move into, you know, these areas. But it certainly looks like, you know, copper we love, and I do think that this is the right place to go because it's got that structural support to that commodity. So, you know, for me, if the Rio falls any further, you know, I think it's a good buying opportunity. Rio doesn't only Rio also give exposure to aluminium as well, as we know that aluminium sort of is a copper alternative, copper derivative. When copper price goes higher, you know, there is a level of a certain product gets converted into aluminium because the gap, so their price tend to be linked. So, you know, Rio gives good exposure to all of that.
All right. right, the market has closed for the week. Let's have a look at some of the leaders today. Codan, of course, those records on its very impressive forecast. DroneShield coming back. We know defence is very much in play at the moment. Energy stocks had a great session with Karoon up 5%. James Hardie coming back, and Eagers Automotive looking good on a broker call up 5%. To the downside, of course, Rio Tinto, with investors a little concerned potentially about this potential merger with Glencore. Nickel, Capstone Copper, Superloop, Guzman y Gomez also some of the losers today. In the small end of town, these stocks had a great day, including Energy Transition, which was up 20%, while heading the other way were some of these players in the small end of town, including Calix, which was down by almost 11%. Well, we know it's all about the non-farm payrolls tonight. For December, the US unemployment rate was at a 4-year high in November. We're also getting European retail sales for the month of November. Now, next week, I mentioned we've got the household spending indicator for November, so just showing us again how much we're opening our wallets. And I don't know about you, but literally everywhere I go is packed. Maybe it's just Sydney, I don't know, but you can kind of see why the RBA governor feels reticent perhaps and does seem to have moved away from any further cuts. Westpac consumer confidence for the month of January always also coming through, US CPI for December. China international trade for December, trade surplus of $105 billion US dollars expected. And on Thursday, we get US retail sales for December as well. We finished lower by 0.1% there on the CBO 200 index, and I will just bring up where the ASX is. Look, it's pretty flat, just down 3 points today, 8,717. And I think if you stripped out that 6.5% loss from Rio, it actually would have been a really good day. Over the last 5 days, the index virtually unchanged. We're still down 4.4% though from all-time highs. We hope you have a great weekend. Stay safe, particularly thinking of all of those caught up in the Victoria heatwave and fires, and those, of course, who've lost their lives. It's going to be a scorcher as well here in New South Wales, so do stay safe. We'll see you all on Monday.